All right, today we're going to dive into one of the most audacious corporate strategies you'll ever see. We are talking about MicroStrategy, a software company that literally decided to stake its future on Bitcoin. So what's really going on here?
That's the big question, right? How does a perfectly successful software company suddenly transform itself into one of the largest public holders of Bitcoin on the planet? It's not just a small investment, it's a complete pivot. What's the master plan?
So, here's how we're going to break it all down. First, we'll look at just how big this bet really is. Then, we'll get into the classic investor problem they're trying to fix. After that, we'll unpack their two-part solution, this idea of digital capital and digital credit. And finally, we'll look at the ultimate endgame.
Okay, let's just set the stage for a second. We need to understand that this isn't just some company dabbling in crypto. This is a fundamental, top-to-bottom reinvention of what the company is.
The company's leadership has said they've literally engineered MicroStrategy to be amplified Bitcoin. We're talking about a massive holding, and it means their company's fate, their stock's performance, is now completely welded to the price of Bitcoin. It's not just an asset on their books, it is their identity now.
So why would they do something so extreme? Well, according to them, they're solving a huge problem, a dilemma that investors have been stuck with for, well, forever. You know the deal. For ages, investors have had what Michael Saylor calls two imperfect options. You've got credit, think bonds. Yeah, it's safe, your principal's protected, but the returns, let's be honest, they're pretty boring. Then you've got equity, stocks. That's where you get the huge performance, the big capital gains. But it comes with gut-wrenching volatility and a whole lot of risk. MicroStrategy believes they've cracked this code, and they're doing it with a two-part solution that's built on top of a single asset. The first part, well, it tackles that high-growth, high-risk side of things.
They call this concept digital capital. The whole idea is simple. Bitcoin is this incredible, high-performance asset, but it's wildly volatile. So to really get the benefit, you can't be a short-term player. You have to have a long-term mindset. We're talking 4, maybe even 10 years to ride out those crazy swings and capture the real growth.
Okay, this brings us to the giant elephant in the room. What happens if Bitcoin completely tanks? With so much of the company's value tied up in it, aren't they just unbelievably exposed? And this is where the strategy gets really interesting. To handle that risk, Michael Saylor says he built a fortress balance sheet. And the secret ingredient to that fortress? They bought most of their Bitcoin by issuing new stock, by using equity, not by loading up on debt. That one move gives them incredible staying power.
So just how much staying power are we talking about? Well, according to their CEO, the only scenario that would actually force them to sell their Bitcoin to pay off debt is, well, it's pretty much apocalyptic. It would take a 90% crash from the peak, and then the price would have to stay down there for 5 straight years. It's something they've prepared for, but they see it as just wildly unlikely.
Now let's look at the other side of the coin. If the main stock, MSTR, is for those high-risk, high-reward investors, what about everyone else? What about the people who want safety and a steady paycheck? This is where digital credit comes in. They've packaged this idea into a brand new financial product called STRC, or Stretch, and it's designed to be the total opposite of their stock. It's meant to be a low-volatility, high-yield instrument that keeps your initial investment safe, and it's all backed by their massive Bitcoin holdings. And here is the number that makes everybody stop and listen. STRC is designed to pay out an 11% annual dividend. And it's not once a year, it's paid out monthly. In today's world, where finding decent yield is tough, that is a huge deal.
So how in the world does this actually work? Well, first, MicroStrategy just holds its Bitcoin, assuming it's going to go up in value over the long run. Second, they basically skim the first 11% of those gains off the top and pay it directly to STRC holders as a cash dividend. And third, this is the really crucial part for safety. The whole thing is over-collateralized by 4 to 5 times its value with actual Bitcoin. That creates a massive safety buffer to protect investors' principal.
And this right here just lays out their whole strategy perfectly. You've got 2 doors into the same house. You can go the digital capital route with their main stock, MSTR. That's for the growth investor who's okay with volatility and is playing the long game. Or you can go the digital credit route with STRC. That's for the credit investor who just wants low volatility, a steady yield, and to know their principal is safe. It's 2 different products for 2 completely different appetites, all built from one asset.
So what's the end game here? What does all of this add up to? Beyond just buying and holding Bitcoin, what is the ultimate mission for the company?
Well, according to their CEO, the #1 goal for their equity holders is actually pretty simple. It's all about increasing the amount of Bitcoin per share. See, they aren't just sitting on their stash. They are actively using their access to the capital markets to acquire even more Bitcoin. And they've even stated a goal of trying to double the amount of Bitcoin that backs every single share of their stock within the next 7 years.
And all of this leaves us with the billion-dollar question. Has MicroStrategy just written the playbook for the future of how corporations manage digital assets? Or are we all just watching the world's greatest, highest-stakes financial experiment play out in real time? I guess only time will tell.